Hello there and hi. This video is about financial statements and it relates to Chapter 2 from your financial accounting textbook. Please read Chapter 2 to get more details as this is a brief overview. So what we're concentrating on at the moment in accounting are two financial statements. The first one we'll talk about today is the classified statement of financial position. And this has another name, also called the balance sheet. On this statement, we have three things. We have the assets, liabilities, and equity. This is called the accounting equation. Assets must always be equal to the total of the liabilities and equity. So the important thing for you to understand at this point in the subject is what is the definition of assets, liabilities, and equity, and also what are examples. So to start with, an asset is a resource of a business. I think of an asset as something that the business will buy to use to run the business. And the definition in the textbook also talks about assets providing future economic benefit. So you can use it in the future to help you make profits in your business. Assets are split into two sections. The first are the current assets. Current assets are expected to be converted to cash or used up within 1 year. So cash is always included. That's my favorite asset. We have short-term investments, and then we have accounts receivable. Accounts receivable is where you have provided the product to your customer, but you haven't got the money yet. You're still waiting to collect the cash from your customer. Usually, you will ask your customer to give you the money within 30 days or 1 week, for example. In that case, you will collect the cash from your customer. So this accounts receivable is then converted to cash, and this should be pretty quickly. We have inventories. When you walk into any shop, all the products that are for sale, these are the inventories of the business. Inventories are what the business buys to sell to their customers. So when a business buys inventory, how long does it take them to sell it? Would it take 4 years or 5 years? Hopefully not. They're hoping to sell the inventory as soon as possible because that's how they're going to make some profits. And then we have supplies. Here, so supplies is a current asset. This might include things like stationery you might need in your business, and you'd expect this would get used up regularly. Current assets are listed in order of liquidity, and liquidity is how quickly the asset would convert into cash. So cash will always be first. Then we have our non-current assets. These will be the bigger assets that you purchase to use in your business, and you would use these for more than 1 year. So this includes equipment, furniture, buildings, land, and intangible assets. Moving along, we have our liabilities. Liabilities is what the business owes, or you can say here it's an obligation of a business. A current liability is something that is due within 1 year. This includes accounts payables, salary payables, taxes payable, and unearned revenue. Accounts payable occurs when a business buys something but they haven't paid for it yet, so they owe the money. And when you buy something, usually you will have a short time within which to pay that money back. Salary payable is when your staff have worked in your business and you owe them money, but you haven't paid them yet. And so usually if you work somewhere, you expect you will get paid within 1 week of working. So these are all liabilities that the business needs to pay within the year. Unearned revenue is a different type of liability. This is where you owe a product or a service. Unearned revenue is when the business has collected the cash from the customer in advance. This means the business has collected the money before they have given the product or service. Now, this occurs with things like aeroplane flights and hotel bookings. The customers will always pay for these things before they get the services. So the airline or the hotel will owe the services to their customers. A lot of students get a little bit confused with unearned revenue, and they think it might be revenue because it does say revenue. But check this word here. Unearned means not earned revenue. And this will belong into our current liabilities. With our non-current liabilities, these are amounts that are due in more than 1 year. These are your longer, bigger liabilities like bank loans, notes payable, mortgages, and bonds payable. Now, the difference between current liabilities and non-current liabilities is quite significant for a business. If I had $1 million and that was due within 1 year, then I would be very stressed. In less than a year, I've got to come up with the money to pay that back. But if I had $1 million and it was due in 30 years, then I would be less worried because I have more time. I have 30 years to make money to be able to pay that back. In the past, there have been some unethical businesses who have moved their current liabilities into the non-current liabilities to make their business appear less risky. Moving on to equity. Equity is how much of the business the owner owns. And if you look at the accounting equation, you can rearrange it, and it shows that equity equals the assets minus the liabilities. So once the business have paid back their liabilities, whatever is left in the assets belongs to the owner. When you're making a balance sheet, you will have two different equity accounts. The first one is the contributed capital, also known as contributed equity. This is the amount that is generated from the sale of shares to investors. This is where the investor has invested money into the business in exchange for a share of ownership in that business. The second item is retained earnings. Earnings means profit, and retained means kept in the business. Why would you take the risk of starting your own business? You do so that you can keep the profits that you make. And so retained earnings is where we record the profits earned by the business. Now, if you're the owner, you may withdraw some of those profits out for your own personal use. This is called a dividend or drawings, and that will decrease the retained earnings. Retained earnings will accumulate every year. So you do need to know how to calculate retained earnings. Can you please pause the video now and write the formula down? So is this what you got? Well done. So retained earnings ending balance is equal to the retained earnings beginning balance. This comes from the ending balance from last year. Then you add the current year's net profit, and then you minus the dividends. Well, we haven't talked about where do you get the profit from. So the profit is calculated on the statement of comprehensive income. This is also known as the income statement, and some companies might call this the profit and loss statement. On this statement, we have all the revenues and all the expenses. And revenues minus expenses, this will give the profit for the business. The profit is what we call the performance of the business. How is the business going? How is it performing? Is it successful in running the business? Now, the profit is always for a period of time. For example, in the annual report, the profit will be for a 1-year period. In a half-year report, then the profit will be for a 6-month period. There are 2 different formats for the income statement. The single step is this basic format where you have all the revenues at the top, then you minus all the expenses underneath, and you get the net profit. This might be suitable for a business that provides a service to their customer. The format I would like you to use is the multi-step format. So this would be used by a business like a supermarket, a retail business where they're buying a product and then selling it to their customers. Now this format still has revenues and expenses, but there's a very specific order, and the order is important. So we start off with the sales revenue. Sales revenue is what the business earns from selling products to their customers. So for a supermarket, when the customer goes in and buys a product, then the business will earn sales revenue. Now this is an expense and it's called cost of sales, and we minus the expense cost of sales. So if I give you an example for a supermarket, first they have to buy the products and then they will sell the products to their customers. So if they buy toilet paper for $5, the cost, and if they sell one roll of toilet paper or one packet of toilet paper, then the cost of sales would be $5. Now, are they going to sell it to their customer for $5? No. They want to have a selling price as high as possible. So let's say they sell the packet of toilet paper for $20. How much did it cost them to get the $20? It cost them $5, and then we can calculate this number here. So the gross profit is calculated, and the gross profit shows the success of the business. How successful is the business at buying products cheaply and then selling them at a higher amount? Now, after the gross profit, we put other income. So other income could simply be other income, or it could be something like rent revenue or interest revenue, could be some examples. Sometimes there is no other income, so you just leave that out. Then we have the operating expenses. I want you to list every operating expense one by one, because if you're reading an income statement, you would be interested to know what kind of expenses this business has. So operating expenses might include salary and wages expense, rent expense, electricity expense, interest expense, insurance expense, depreciation expense. These are all different examples of expenses. Then we have another calculation, which is the profit before tax. To calculate this, it's your gross profit plus the other income and minus the operating expenses, and this will give you the answer for profit before tax. Income tax expense is shown separately because you need to know your profit before you can get this number. And then finally, you get your net profit, or some companies call this profit for the year. Okay, how to calculate the net profit? It's the profit before tax minus income tax expense. So I'd like to demonstrate how to do the following exercise, and I'd really like you to do this with me. So can you make sure that you have this question either on your computer screen or you have a printout of this question? You can find this document in Canvas. So here we have the business name is Zhiheng Sales, and we've got the period of time for the year ended 30 June 2019. We need to prepare a statement of comprehensive income. We need to calculate retained earnings, and then we need to prepare a balance sheet. So the statement of comprehensive income includes two items. It includes the revenues and the expenses. So I'll show them as an R or an X. On your balance sheet, we have three items. We have assets, we have liabilities, and we have equity. And what we've just looked at in this video is that with assets, there are two types. We have current assets, and I'll write it like this, non-current assets. And then current liabilities and non-current liabilities like that. So the first thing I would like you to do is from this list here, could you identify, is it R for revenue, X for expense, or is it one of these? Everything in this list will be one of these. You can use the notes we just looked at to help you. So pause the video now, fill that in, and when you've got that filled in, start the video again. Is this what you got? Can you check to see? I put dividends as equity because I'm going to use dividends to calculate the retained earnings. And notes payable is similar to a bank loan, so that will normally go into the non-current liabilities section. Okay, the first step is to start here with preparing the statement of comprehensive income. Now I'm going to use the multi-step format that we just looked at. So to do this, we need the revenues and the expenses. So, one item is down here on the next page. That is your sales revenue. Sorry about that. I didn't see that one. I'll include that there. I'll just try and pull this up. Okay, so there's our total list. So we need to find our revenue. So I'm going to start with sales revenue. So I'm going to highlight that first. And then we need to minus the cost of sales and calculate the gross profit. Please pause the video now. Could you complete the income statement? And then we'll check our answer together. So is this what you got for your statement of comprehensive income? Don't forget you need to start with a beautiful heading. With your beautiful heading, it should be the who, the what, and the when. The who is the business name, the what is what statement are we doing, and the when is the date. And your date needs to follow this exact format for the year ended 30 June 2019. So first of all, I wrote down the sales revenue and the cost of sales. The gross profit is then calculated, sales revenue minus cost of sales. We get the gross profit. Then you go back up to the question and you see that there is some interest revenue here. So we need to get the interest revenue, and that is listed under the gross profit. And then we need to find the expenses. So we have advertising expense, we have income tax expense here, but for this expense in particular, we're going to save that for the end, and I can see salary expense here. So I have listed both of those expenses. I put brackets there because the expenses are a minus. Then I have calculated the profit before tax. Now, how to get this? It's your gross profit plus the interest revenue minus advertising expense and minus salaries expense. This equals profit before tax. Then we list our income tax expense and we get our net profit. The net profit is the profit before tax minus income tax expense. Okay, once that is calculated, our second step, if we take a look at the question, is to calculate the retained earnings. So you need to know the formula for the retained earnings, and we noted that down earlier today. Can you please pause the video? Can you please write down the formula and can you then calculate the retained earnings? Okay, here is our formula for retained earnings. It's the beginning balance, and the beginning balance comes from the information in the question. So this is interesting to note that the number in this list for retained earnings is the beginning balance. That means during the year we didn't make any changes at all to this account. So we've got the beginning balance. What else do we need? We need the net profit, and the net profit is this year's net profit. And we also need the dividends as well. Now, if there's no dividends given to you in the question, then that means dividends is 0. If there's no retained earnings given to you, that must mean it's a brand new business and there hasn't been any profit in the previous years. And so our retained earnings will be $63,940, and this is the ending balance of the retained earnings at the 30th of June. So our next step is to do our balance sheet. And our balance sheet has 3 things. It has the assets, liabilities, and equity. So I start off with the beautiful heading, the who, the what, and the when. Who is the name, what is the balance sheet, and when is the date. Now, for a balance sheet, you write the date in this format, as at 30th of June, because the balance sheet shows you the ending balances. Now, on the balance sheet, we start with the assets. Now, for this balance sheet, I would like you to put assets into 2 groups, current and non-current, and same for the liabilities. Could you please pause the video and could you please complete this balance sheet? So to do the balance sheet, we start off with collecting all the current assets. So I have cash and then I have inventory. So we add those up and that's your current assets. We have one non-current asset, which is the equipment, and so we'll include those on our balance sheet. We add up the total and get the total current assets, but because there's only one non-current asset, that would be the total. And then to get total assets, you add current plus non-current equals total assets. From the question then, we need to find the expenses. I might just highlight that because we have already used that expense. Sorry, we now need to find the liabilities. So in this question, I have one current liability and I have one non-current liability. So I'm going to have one section for each of those, and I'll include that there. The total liabilities will be add both of those up. Now for equity, we have 2 parts. We have the contributed capital from the question. Now if you go back up to the question, you can see that's the last thing. When you get to the end of the question, you should have highlighted everything and used everything. And this is why I like to either highlight or cross it off as I use it. So if I get to the end and something is still left, then I know, okay, where do I put that? So we include the contributed capital and then we also include the retained earnings. Now this number is probably the biggest mistake that students make. Many students put the wrong number here. So what number do you need to put there? You need to put the number that you calculated for retained earnings. Don't include the beginning balance. You have to calculate the ending balance and then include that on the balance sheet. So add these both up and that's your total equity. Last step is to add up your total liabilities plus your total equity, and that should give you the same number that you got for your total assets. And that is when your balance sheet balances. If it doesn't balance, it doesn't mean you will fail the question. You could just have one thing in the wrong place and you could still get a distinction in an assessment question. The secret to getting this right is practicing. So go and practice this question again and have a look at the other practice questions I've provided for you. I always say practice, 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 and then repeat, repeat, repeat. Don't just do it once, do it many times. Good luck. And if you have any questions from this video, can you post it in the discussion board for week 2?